Good afternoon, everyone, and welcome to today's ShareWise Investor webinar. I'm Wei, founder of Homodeus Research, and I'm very pleased to be joined by Andrew Schwartz, Group Managing Director and co-founder of Qualitas. Now, for those newer to the story, Qualitas is listed on the ASX under the ticker QAL and is one of Australia's leading real estate alternative investment managers. The business has $10.9 billion in funds under management, built over 18 years of investing throughout the market cycle, and has financed real estate now worth over $40 billion across residential, commercial, and build-to-rent sectors. What makes Qualitas distinctive is where that capital comes from and where it goes. The business is predominantly backed by institutional investors and disclosed in the FY26 half-year results presentation. Approximately 80% of the capital is deployed into the residential sector. That is precisely where Australia's housing shortfall is most acute and where the major banks are structurally pulling back. Qualitas sits at that intersection. Since listing on the ASX in 2021, the business has more than tripled funds under management and available capital. As disclosed at the Macquarie Conference presentation on the 5th of May 2026, it is asset light and highly scalable. It has a long-term funds management EBITDA margin target that has been upgraded from above 50% to above 60% for the Australian business, as disclosed in Qualitas's ASX announcement on the 26th of June 2026. The growth runway is also broadening. Qualitas recently reported a record year-to-date deployment pipeline of $7.4 billion as of April this year and has now taken its model global, with an expansion into Europe real estate, commercial real estate financing market, a market more than 5 times the size of Australia. With that, I'm delighted to hand you over to Andrew. Andrew, welcome. I understand you're in London where it's 6:30 in the morning, so thank you for making it up so early to take the time to take us through the story.
Thanks a lot, Wei, and good afternoon for everyone on the call. Before I start, I do have to give an important disclaimer, and that is Qualitas is currently in its blackout period. And what that means is under our market disclosure policy, I can't provide any new financial information today, so I won't be able to provide performance numbers, really nothing new in the sense of financials. Everything I say has already been in the public domain, released to the Australian Stock Exchange. Specifically, I'll be referring to Macquarie Conference presentation I made on the 5th of May 2026, a European announcement we made through the ASX on the 12th of June 2026, and our recent AI update on the 26th of June 2026. Unfortunately, I won't be able to comment on current trading, any earnings outlook, anything not already released to the Australian Stock Exchange. And to be absolutely clear, it's not product and financial advice. So that's the disclaimer. But having said all of that, let me turn now to really the fun part of the discussion. And I want to really start with something really simple, which is who are we? And Qualitas is an alternative real estate asset manager. We invest in private credit, putting it into plain English, we lend money. And our borrowers are real estate owners who need structured financing solutions, financing that the banks won't generally give to them or can't give to them, or perhaps they're not fast enough to provide at scale. And most of our capital is institutional. It comes from the big global pension funds and the sovereign wealth funds. We also run a listed fund on the Australian Stock Exchange. It goes under the ticker code of QRI, and that gives everyday retail investors access to exactly the same assets, the same income, the same exposure as being enjoyed by our institutional investors. We've now been doing this for over 18 years, but our senior team has decades more experience, well before we commenced the firm, of 18 years. I think it's fair to say, we've lived through lots of credit cycles. We know what they mean for asset values, for lending behavior, and for risk.
Excellent. Thank you for the overview. So, Andrew, the first topic I wanted to broach in today's discussion is growth through the rate cycle. Over recent years, we've seen 13 consecutive rate hikes, followed by the start of cuts. Now, based on what you've already disclosed to the market, can you explain the structural dynamics at play for Qualitas's business model?
Yeah, it's interesting as we disclosed in the Macquarie May 2026 presentation. Um, Beginning in around 2022, we've had to endure 13 rate hikes. And, the most interesting part about that is it was actually the strongest period ever for Qualitas. And here's why. When interest rates rise, liquidity tightens, the banks pull back from a construction lending all the way to development lending. The bank's credit criteria gets tighter, more projects fall outside what they'll fund, and borrowers who'd normally go to a bank come to someone like Qualitas instead. And it's not just a gap we feel only when times are easy. It's a gap that always exists. And it gets bigger when credit tightens, credit tightening being the rising of interest rates. And I think, Wade, there's a second dynamic as well. We lend at floating rates. We're tied, our base rates are tied to what's known as the bank bill swap rate. So when interest rates go up, our interest income goes up with them. And if you compare that to, say, an equity investor, when you have higher rates, it compresses asset values. Their returns go down, basically get compressed. But for us, it's actually the opposite. A higher interest rate environment increases the financier's profit share. And that is exactly why, as I set out at the Macquarie presentation, higher rates make credit strategies more attractive to global institutional capital. And I think the numbers back all of that up. As as I disclosed on the 5th of May 2026, our financial year-to-date deployment pipeline was up 46% year on year to $7.4 billion. So certainly significant momentum there.
Hmm. Yeah, that's really interesting, and I guess it's somewhat counterintuitive to what I would have thought. So it's good to really understand that. And how many economists are forecasting that we are near the end of the rate hike cycle now with the potential rate cuts next year? Does that change the picture for Qualitas?
That's a very fair question. And, it's probably a logical flow on from me saying, better times when interest rates are being hiked. But I would say that, uh, we do also, benefit from when loans reprice lower. And there's a number of reasons for why that is also a good environment for a firm like Qualitas. When you think about it, lower interest rates means there's more activity that's going on in the market, more volume, more demand for capital. And that actually means more opportunity for managers like us. And underneath all of it, I think that there's really two structural trends that don't really care or intersect with what rates do. And the first one of those is really about the scale of your operation. Um, if you look at projects and just the general cost, in inflationary times, costs have gone up over extended number of years. Asset values have gone up, and so the projects that we finance become bigger. And the bigger the projects, you need more institutional grade capital in order to meet the volume of money that is actually required. And not many players can literally write a check over $200 million, but Qualitas can. And that's a real barrier to entry for other people. And if you think about it in a lower rate world, it only gets stronger. The more projects become feasible and the pipeline for institutional scale lenders, really keeps expanding. And I think there's a second factor at play here, and that really is the market structure that we operate in. Australian commercial real estate is still very bank dominated. alternative financiers are only 20% of the total market. And if I compare that to, say, the United States and the UK, it can be closer to 50%, sometimes even more. And regulation keeps pushing the banks out. That retreat doesn't depend on the cash rate at all, whether interest rates are going up or down. It's very structural. But here's really the important point, I think. We're a funds management business. Our earnings are reoccurring and we're not rate dependent. We earn revenue through base management fees, transaction fees, and they grow with fee earning fund, with deployment, regardless of the interest rates. So as disclosed in the first half 2026 results, which released to the market in February 2026, our fee earning fund was up 38% to $10.9 billion, and our deployment was up 57% in that first half. And we do a lot of construction, which progressively draws down over time. And each and every time those facilities draw, so our fees keep building at the same time automatically. So I would say, Wei, it's a very resilient model across the cycle, relative to whether rates are actually going up or down. And maybe just to finally add to that, there's four drivers that I think support overall what I'm saying. Firstly, there continues to be a chronic residential supply shortage that sustains demand for financing. There's increasing project scale requiring institutional capital that really only a handful of platforms can provide. There's a structural shift toward alternative financing as banks continue to retreat from that sector, and a reoccurring earnings base that grows with fee earning FUM rather than with rates. So depending where we sit in the rate cycle, I think one driver runs harder than the other, and deployment, whether that be deployment or whether it be capital inflow. For people who know me really well, I always like to use aviation analogies. Aviation's a real passion of mine. And, if you sort of use the analogy of a twin engine plane, a left engine and a right engine, pilots, when they're learning how to fly, they learn what's called asymmetrical flying, which is, what do you do if you lose your left engine or your right engine? And how do you continue the plane to be straight and level, if not ascending? Or you might have one engine spinning more than another at any point in time. And if you think about capital raising as one engine and deployment as another engine, and you think about interest rates and how they may impact your deployment engine versus your capital raising engine, I think you can fly the plane and ascend. And it's really just about your training to be able to recognize the conditions you're in, adjust the controls appropriately, and fly the plane, or in our case, run the platform.
That makes a lot of sense. And, given that you've got four drivers, you're almost more like a drone than a twin engine. You've got, multiple levels of diversification.
It's so true.
Well, what about capital stability? So how should investors think about the resilience of Qualitas's funding base if the market volatility picks up?
Oh, I think that's an important point, and it's structural. Again, as I think I discussed this at the Macquarie May presentation, that more than 90% of our committed fund sits in closed-ended or listed structures, and what that means is investors can't redeem until the fund matures, or they trade on the market without us needing to sell the underlying loans. Only 10% of our capital is redeemable at all. And of that 10%, only 1% can be redeemed on a quarterly basis. And the rest of it, so that's the other 9%, is locked in for 2 years minimum from each individual's original investment commitment. So you may ask, well, what does that mean for us in practice? And what it means is our capital base is really highly stable. Exactly when other managers might be experiencing outflows, the vast majority of our capital is perfectly matched. And it means we can make these really long-term, confident commitment to the borrowers because we've really got the certainty of capital. And, the numbers sort of speak to that. Our funds under management grew from 9.5 billion to 10.9 billion over the 6 months to 31st of December 2025. And, we disclose that in our first half 26 results. And over 80% of our fee earning FUM under performance fee arrangements are currently exceeding their hurdle limits as at the end of December 2025. So I think that really all speaks to it.
Mm, mm. That makes a lot of sense. The next topic I'd like to discuss is, as previously disclosed, I beg your pardon, previously disclosed strategic developments. So, Andrew, you've made two significant announcements in recent weeks. One is the European expansion and the AI platform update. Can you walk investors through what was disclosed and what the strategic rationale is?
Yeah, thanks, Wade. Like it really is two of my favorite topics at the moment, and certainly getting asked a lot about both of those. And both were disclosed to the ASX in June 2026. Let's start with Europe. And as we disclosed in June, we acquired a business in London known as Stars. It's a UK-based credit commercial real estate credit manager. And the thing we liked most about Stars is the fact that it's a pan-European manager as well. And that really meant for us that, we've moved out of Australia and although Australia, will always be a core business for us, and opened our first European office. And you really think about the scale that provides to us. The UK and European credit markets is roughly 2 trillion euros, and that's 5 times the size of the Australian market. Banks still control 80% or more of the financings in places like Germany, France, Spain. And interestingly, they're retreating. Basel III capital requirements are forcing them out of the market. The funding gap across 20 European countries is over 70 billion euros, and that's over the next 3 years. And it sounds familiar, right? Like it's exactly the same setup that we built on, the Australian platform on. I think the second question you asked me there was around AI, and again, we disclosed this towards the end of June to the ASX. We've now got a dedicated AI team, enterprise-grade tools. We've rolled out across the entire business. And you might ask, why does it matter? And it matters because AI is a platform enabler. It drives efficiency, and over time, we expect that to really drive our margins. And that's why in that exact same announcement, we upgraded our long-term EBITDA margin target for the Australian business. And we announced we're looking to grow EBITDA margin from above 50% to above 60%. And we announced our intention to implement an AI investment platform based on 18 years of our own track record, something really special in my opinion.
Mm, mm. I mean, I've learned a lot about AI, and I think having that data lake and that track record is probably something that's going to be very unique for yourselves. That European opportunity, though, just coming back to that, I mean, 5 times the size, that's massive. Can you provide more detail on the European expansion? Only stuff that you've already disclosed, of course.
Sure. Look, I think it was all about, we should buy and not build ground up. That was a really deliberate decision by us. We're entering a market that is incredibly sophisticated, and trying to do that without a team or a portfolio or established relationships would have been slow, hard. I think it would have been a much more risky approach for us to do that. And really, as I set out in that June 2026 announcement, Stars, name of the business in Europe, gave us a functioning platform from day one. They managed 376 million sterling commercial real estate loan portfolio across 11 investments. They're backed by a very large sovereign wealth fund and institutional pension fund. Their own capital relationships very much complement our own investor base. I think I said earlier that the vast majority of our investors are institutional at Qualitas. Just focusing on the numbers themselves, the total consideration for the purchase was in Australian dollars, $36.5 million. 28 million of that was co-invested directly into the Stars portfolio through co-investments. The rest was mostly cash that was just sitting in the business. So, most of our outlay for the business has already been deployed. It's already, generating returns for us, and the deal closed immediately upon signing. So, for us, day one was operational. We're live on that now.
Excellent. Now, coming back to topic du jour and probably my own passion, the AI side of things, can you explain what was disclosed about the AI platform during that 26th of June announcement?
You keep coming back to my favorite topic, mate. Look, no, seriously, it really is. I think in practical terms, what AI does is it lets our team process more information more consistently and faster, more efficient, basically. And maybe I need to be a bit more specific about what I mean by that. And again, I disclosed this in the June 2026 ASX presentation, but we do about 40 to 60 investments per annum. And each one of those is very data heavy. A single transaction can literally carry 160 documents, maybe even more. And, we're dealing in a lot of borrower information, builder information, cash flows, legal structures, pre-sale reports, development approval terms and conditions. And, someone has to extract those right data points. Which ones matter more than others do. Confirm, triangulate the information, confirm it's all correct. Often across sources that don't even, necessarily, really agree with each other. And if you sort of stand back from, what I've just said, it's super labor intensive work. It always has been over the start of time. So I think we've built something really special. It's a proprietary AI-enabled credit execution platform. It was something we built. We purpose-built it for our business. It combines large language models. It brings machine learning into it. And it's really, we've overlaid that with 18 years of Qualitas institutional knowledge. We've, overlaid it with more than 400 proprietary investment committee papers. It's not a generalist tool that you can go and replicate, right? It's specific to what we do and our firm and our track record and our IP. And the results are really the following, that credit papers that used to take us days will now take hours. The platform runs more than 370 verifications and checks per transaction. It produces literally 200 pages of over 200 pages of analysis just for a single investment. I think, Wei, I also need to be clear about what it's not, right? As excited as I'm sounding, is what it's not is we're not handing decision making over to machines, and I need to be really clear about that, right? This business is built on judgment, and human wisdom, and investment decisions stay firmly with our investment committee always. Right? It's not about it going to the machines. But what it does is it gives us capacity, it gives us productivity, and really the ability to scale the business, and it frees our people, right? Like enables them to focus more on origination, on analysis, on their levels of conviction, on making risk judgment calls. And I think that the real prize in all of this is that all of a sudden, AI decouples our fund growth from our headcount growth, right? As we now start to scale more and more, we don't have to scale costs at the same linear rate as we do our funds under management. And we were, for that reason, comfortable coming forward and saying, that supports a margin target upgrade as I disclosed in that June 2026 ASX announcement. Super exciting for us.
No, it makes a lot of sense, and it's really just about distilling that information rather than extrapolating, right? So, I can see how it can really improve the productivity of the team. Now, the third topic I'd like to delve into today is one pretty recent, which is the federal budget tax changes and what they may mean for real estate private credit. So, the budget introduced changes to negative gearing and CGT. Can you explain clearly what's changed and why it matters for the real estate private credit sector?
Yeah, there's some. I like the order you're doing this in, where we go AI to tax changes, right? Um, but look, there were really two substantive changes. I think for investors buying existing residential property. So just to be clear, I'm very focused on existing residential property and what I'm about to say. But the first
Right.
was around that negative gearing, that rental losses can no longer be offset against your other taxable income. And secondly, it was around the capital gains, that the old 50% discount is now gone. And
Mm,
it's been replaced with this inflation indexation model where there's a minimum of 30% tax on the real gains, but you do get the benefits of indexation of that inflation. But I think, in terms of what's the critical detail of that, both changes apply really only to established property. Interestingly and really importantly, new housing is exempt from both. And the government, their intent was clear: redirect the capital away from existing stock toward new supply. And the question then is, so how does that impact Qualitas? Why does it matter? And Qualitas lends to developers building new homes. We're not somebody that is lending money to investors buying existing ones. We're a wholesale commercial lender. And so when you really think about the policy direction here, it's about giving more incentive to build and less, incentive to buy existing homes. And I would say that's highly supportive for a firm like Qualitas, who's, a very large financier of development projects around Australia. So if I think about, the environment we operate in, development financing is really a key part of our portfolio. And I'd say the policy direction is very supportive of our business.
mm, mm. So, the million-dollar question, what happens in the near term as the market digests these changes?
Maybe it's more than the $1 million question, mate. But but I'd say that you're talking to a fund manager that manages 10.9 billion here.
That's right.
Yeah, but
Yeah. Billion's a
I would say,
big number for me.
for all of us. I would say I think we should expect a period of recalibration in the market. Probably buyers and sellers will pause a little bit and pontificate about the environment we just find ourselves in. They'll assess the
Mm,
implications. I'm guessing, probably a bit of a wait and see. I think potentially, you could experience some softening in off the plan pre-sale activity, albeit that the policy direction of government is not at all, focused on, that part of the market. And it could be for firms like Qualitas, we do what we call more, residual stock financing, where, we're looking at inventory within buildings and providing, one line type financing. But I think the other thing you've got to remember is, and here's probably the real context is, the projects that are currently under construction or in planning, they mostly have a 2024, 2025 vintage about them, right? When you think about, the sort of work that Qualitas does, developers have been working on, by the time we're financing it, it's late in the piece, right? Developers had to go and buy the land, to get their designs, development approvals, then they do their pre-sale campaign, and then they finally come to Qualitas for financing. So you're currently working on vintages of 2024, 2025. Developers have already committed very significant equity to these projects well before, these changes existed or were mooted. And, delaying it now or unwinding a project now would just crystallize losses for those developers, and there's just no upside in that, right? And I think that's where the opportunity actually lies, because the uncertainty makes traditional financiers more conservative. We've seen that over and over again through many decades. When basically you've got tightening criteria type environment, which is what we're currently experiencing. The traditional financiers, they react by, raising their pre-sale hurdles. They tend to push for, many viable projects all of a sudden, fall outside of their box that would have previously been within their sandbox. And as I said, we've really seen this dynamic before. It increases, the net result is it increases the demand for alternative financing, from groups like Qualitas. And our underwriting already assumes material price softness in what we do. When we run our downside scenarios, when we're underwriting investments, loan investments, we make assumptions in regards to the fact that some of these pre-sales may default and prices may soften, and we do that, well beyond what the current forecasts are. I mean, maybe the only last point on this, and maybe the only other thing to think about here is that when you think about sort of the largest decline in Australian housing values over the last 40 years, from our research, it was 14%, and that occurred in 1989. And so, when we underwrite, we really underwrite to withstand scenarios, well beyond that.
Yeah. So there's a lot of resilience, I think, built into your business model. And I think those tailwinds, as you mentioned, with the traditional financiers pulling back. What about the longer term implications? Do you think this is a structural tailwind or something that introduces sustained risk?
Look, I think once we're beyond this transition period, we continue to see structural tailwinds, and I think there's several of them. First, the policy really redirects investor capital toward new construction. I've really laboured that in your earlier question. And, right now for, every one investor that buys off the plan, there's around 20 that are buying existing dwellings. And even a modest shift in that ratio means more meaningful new demand for development finance. I think the second tailwind I'd say is, we sort of expect a mix of the new projects to change as well. Recent developments have skewed more towards owner occupiers, but new builds that keep both negative gearing and those capital gains tax concessions. So you'd expect really investor demand should start to rise for those new builds, and those new builds should really respond to that target market. And I think that the smart developers will respond accordingly. They'll look to have more investor focused projects. Historically, only a small number of apartments under construction generally targeted, yield driven investors. But I think on balance, my view is that that share should and probably will grow. And as you have sort of a bigger investor targeted projects, those bigger projects are just going to need bigger debt packages. And again, I think that favors financiers such as Qualitas, who can deploy at scale. So I think they're tailwinds for us. Maybe one other tailwind there is really around the rental growth. Again, this is just personal opinion I'm putting across, but if you've got less investor activity in existing dwellings, that's actually going to tighten the rental pool, right? That actually means rents will rise. And I think that's good for things like, the build to rent sector. It's a sector that we're, very active in terms of both debt and equity. And it makes investor grade apartments, more viable to actually build. You're also seeing this shift, I think, going on in the market for away from capital growth because of potentially the changes to the capital gains tax base, may lead to changes in how people think about investing in capital growth towards income, that being the really important part of an investment strategy. And I think when you think about credit strategies are all about income. And so, again, I think it does, really favor the type of investments that Qualitas does, which is credit, it's income. It's really consistent with the shift in some of the policy and the implications of it.
Right. There's so many implications from the budget. It's hard to, I guess, put them all together. What's the single most important thing you'd want investors to take away from the budget changes?
So one of those questions where you're saying, like, if you don't remember anything else, just remember this one thing about what
Pretty much.
we're
That's pretty
talking
much where
about.
my head's at this point in time. So,
Yeah, no problem. I think the one thing I would say is that the policy direction really reinforces demand for alternative real estate credit. Like, again, just follow the chain of what we're saying, right? More investor demand for new apartments means more projects. More projects outside of the bank parameters because the banks get conservative under that level of uncertainty means more demand for us. Bigger projects means bigger debt packages. Again, favors the lenders who operate at scale. Rising rents supports build to rent. And the shift from, capital growth to income really favors credit strategies. And I think every one of those dynamics, points in the same way, really towards alternative credit, and it points towards strategies like ours.
Andrew, that was a great conversation. Unfortunately, that's all the time we have for today. Would you like to provide some closing remarks?
Look, firstly, thank you for having me come along and explain what Qualitas does, and for everyone who's given time this afternoon to, join the webinar. But let me just try and bring it all together, very briefly. We're a funds management business. We've been operating for 18 years. We've now got a European platform through the Stars business. We've AI-enabled credit execution platform as we disclosed in June. And I think that we're really excited about what the future holds. Again, just in keeping with compliance, I do need to say everything I've talked about today, it's all in the public domain. Specifically, if people are interested to learn more about it, there was the Macquarie conference presentation on 5th of May 2026. The European expansion is really detailed in our June 2026, and AI investor update was also detailed in June 2026. All the information is on the ASX. You can also access it on our website at qualitas.com.au. So it's all there. And just one other reminder is, we are in that results blackout period. So unfortunately, I wasn't able to make those new disclosures, but I hope people got a lot out of our discussion today, and I certainly enjoyed, coming along and talking to everyone about it.
Thank you, Andrew. Well, I learned a lot. So thank you for sharing your time, especially so early in the morning. And thank you to our investors for joining and your continued support. That concludes today's session. Thank you.
Thanks very much.